Hello, welcome to lecture 1 of module 9, which is going to delve into the financial forecasting, which is more or less the underlying premise when we are talking about the financial decision making at the end of the users community. We all know that decisions irrespective of different financial variables or financial conditions or financial activities are going to have a bearing on the future states of affair related to finance. And to arrive at rational and informed decisions, there is no other alternative but to go for an act of foretelling the financial variables and the values what they are going to assume down the line in the future span of time, so that the decisions related to future span of time can be objective and rational. In the literature of finance, when we are talking about the act of foretelling different financial variables or financial forecasting, it earned a significant place owing to the simple reason that financial forecasting facilitates us to make a journey into the future states of affairs of a business. Now, let us discuss about the concept of financial forecasting. When we say forecasting, it simply refers to the task of telling beforehand about the financial variables or financial matrices. But the question is, why do we do so? The simple answer to that is to have better understanding and idea about the financial position in one hand and the financial performance on the other hand, which is going to facilitate different users so far as their decision making activities are concerned, backed by manifold objectives with which they are getting access to historical as well as prospective financial information. Hence, financial forecasting facilitates the prospective analysis of financial statements which otherwise contribute significantly towards the task of decision making at the end of the varied stakeholders community whosoever are carrying their whatever objectives. Now, when we are talking about the concept, the technique of estimating or projecting a company's future financial results using market trends, historical data and a variety of assumptions is known as financial forecasting. The aim is to assist business with financial stability, decision making and future planning. In order to forecast how these elements will change over time, it entails examining a number of financial performance matrices for a business, including sales, expenses, profit and cash flows. When we are talking about the conceptual dimensions of financial forecasting, as I had already made a mention of the fact that it delves into the future states of affairs of a business in financial terms. Now, the future financial states of affairs are heavily conditional upon the market pervasive movements, the underlying conditions and the futuristic efficiency with which the business is going to execute different functional activities related to different domains of the business. And in this context, as we all know, when we are talking about finance, we are talking about the twofold dimensions. One is the revenue, the other is the cost. Now, there are different activities which are leading to revenue generation, and at the same time there are different activities or the components of cost which are more or less related to the execution of different activities by committing different forms of resources in the business organization. So, financial forecasting accumulates all the financial components, might be related to recurring orientation, might be related to one-time orientation, and trying to project the values what these financial variables are going to assume in a future span of time, so that we can have a better understanding about the financial states of affairs conditional upon the future span of time. Moving further, when we are into the protocol of financial forecasting, there prevails different types of financial forecasting. Now, the genres which are made available in the literature of finance are manifold, but we are decomposing all these categories of financial forecasting into two broad heads. One is qualitative forecasting and the other one is quantitative forecasting. Now, when we are talking about quantitative forecasting, obviously it is going to be heavily inclined towards the past data and information, and we are there to project different trends. We are talking about the seasonal movements, we are talking about the impact of different market pervasive variables, we are talking about the causal relationship that different financial variables are going to have among and between themselves, so that we can make use of different mathematical and statistical techniques in order to predict the values of different financial variables, what it is going to assume in a future span of time. So, there prevails an array of quantitative techniques which leads to financial forecasting activities, and more or less on a scientific orientation, we always prefer to go for quantitative financial forecasting rather than the subjective or qualitative financial forecasting when we are talking about informed and rational decision making at the end of the users community. On the contrary, when we are talking about the qualitative financial forecasting, we are using judgments, we are using opinions, we are finding the responses and the experiences of the experts in the so-called field, and we are gathering all sorts of information which are collected from all these individuals who are in a position to contribute towards the task of talking about the movement or vulnerability in financial variables and its exposure down the line in a future span of time, so that we will be in a position to talk about the values of different financial variables. But the fact remains that qualitative financial forecasting is more or less a subjective approach without making much use of the data or the past information into its orientation. Moving further, there are different key components of financial forecasting. In general, when we are talking about financial forecasting, we are more or less adopting a holistic approach. But pragmatically, when we are going to execute the task of financial forecasting, we are there to fragment different items into different subcategories, and we are there to foresee all these financial variables which are similar or alike in some way or the other, and we are trying to project the different variables of the financial statements, the cash flow statement, the income statement, or any other financial document which is capable of providing sensitive and cogent information to the users community to better understand and read the financial states of affairs in a future span of time. Now, to start with, the major key components are revenue forecasting, which is going to talk about the future quantum of revenue that the business is expected to generate conditional upon different internal factors, say internal efficiency and effectiveness with which different recurring activities are going to be executed, and on the contrary, the external forces, the economic conditions, the social issues and the market pervasive forces which are going to influence the revenue generation capacity and capability of the business organization. In totality, when we are talking about forecasting revenue, we are indirectly talking about the quantum of sales along with the market share conditional upon the market size in a particular sector of business and how much value the business is going to generate in and around the same states of affairs when we are talking about the revenue forecasting. Then there comes the expenses forecasting. We all know, I had already made a mention of the same, that whenever we are looking at business and financial orientation, we encounter two different facets. One is the revenue orientation, the other one is the cost orientation. Hence, after forecasting the revenue, we are there to go for the act of foretelling about cost. When we are talking about cost, they are dynamic, they are varied, and they are diverse. So, it is practically a very difficult task to predict or to project different components of cost associated with different functional domains of a business, but financial forecasting in its quantitative orientation facilitates that particular task of predicting the different components of cost, whether it is variable in nature, whether it is fixed in nature, whether it is semi-variable in nature, or whether it depicts a typical attribute like step fixed cost or any other dimensions of cost based on different bases of classification. So, in totality, when we are talking about forecasting of expenses or cost, we are there to take into consideration the internal states of affairs, and at the same time we are there to inculcate all those external forces which are going to have a bearing on the movement in cost, whether it is going to diminish or it is going to magnify down the line in a future span of time. Then there comes the third, that is cash flow forecasting. Now, cash flow forecasting leads to the forecasting of cash, both inflows and outflows emanating out of the execution of different activities in the business, both recurring and non-recurring, and we are normally predicting the cash inflows and outflows pertaining to different sub-components of cash flow statement, namely operating cash flow, investing cash flow, and financing cash flow, and accordingly we are accumulating all these three sub-components of cash flows, addressing inflows and outflows of cash as a consequence to different activities which are getting executed in the business, and we are in a position to foresee how much cash is going to be generated on a net basis in a future span of time, so far as a body corporate is concerned. Then the fourth component is profitability forecasting. We all know that profitability forecasting is more or less dictated by the forecasting of revenue and the forecasting of the cost components of a business. So, when we are talking about forecasting the profit or profitability of a business, we are making a face-off between the forecasted revenue items and the forecasted cost components, so that we are in a position to talk about the profitability of the business down the line in a future span of time. So, here we are projecting company's ability to generate profit, the magnitude and the quantum of profit what a business is expecting to generate by considering the forecasted revenue and the forecasted cost components. Then the last one is capital expenditure forecasting. Now, when we are talking about capital expenditure, essentially we would like to read well in advance how much of capital is going to be committed in the form of fixed assets down the line in a future span of time, because capital expenditure is not recurring in nature, rather they are one time, or they are normally executed after a gap of a span of time. So, when we are talking about investment in assets leading to capital expenditure, we are there to be very cautious, owing to the simple reason that they are irrevocable decisions, and there is heavy prevalence of blockage of capital in the form of fixed assets if our decision down the line in a future span of time will go wrong. And why we call it, it is very sensitive, owing to the simple reason that there is heavy element of risk associated with commitment of capital in the form of assets in a business organization. But on the contrary, we all know when we are expecting growth, diversification or expansion of business, we have no choice but to resort to different capital investment decision, and we are there to assume that risk in the anticipation of fair or reasonable return what we are expecting to generate by committing capital in the form of fixed asset down the line in a future span of time. Moving further, when we are talking about need for financial forecasting, there are a bundle of consequences of financial forecasting, and the need for financial forecasting is immense when we are looking at the varieties of financial decisions to which all the users community are inclined to for serving their vested objective. To start with, the first need for financial forecasting is informed decision making. In the intro of financial forecasting, I had made a mention of the fact that when we are talking about the task of decision making can be executed on a subjective orientation backed by our hunches, backed by our prejudice. But on the contrary, we all expect to have financial decision which is based on a very fundamental premise related to data, related to facts. And if you are going for financial decision making backed by the underlying premise of data or facts, obviously we are in a state of executing decisions in an informed and rational manner. And financial forecasting solves that very purpose of providing input information and data whenever we are resorting to the task of financial decision making in an informed and rational manner. Then there comes the second, which is budgeting and planning. We all know budgeting simply refers to the quantification of different items of financial variable well in advance for a designated period of time in order to know what quantum of resources are required to execute different activities related to different functional domains of a business. And on the basis of budgeting, we are executing different short-term, medium-term and long-term plans which are ultimately going to contribute towards the very objective of profit maximization leading to wealth maximization and finally maximization of the value of the business. So, with the availability of data related to a future span of time, obviously we are better off to accomplish that objective of value maximization of a business by using those financial information extracted as a consequence to financial forecasting. Then the third is risk management. The risk is inherent in each and every business when you are going to talk about the future of business. We do not know exactly what is waiting for the business down the line in a future span of time. But we all know that the future is vulnerable and exposed to different categories of risk, may it be internal, may it be external, may it be cross. Now, it is imperative on the part of the business to go for a quantification of the extent and magnitude of risk, and accordingly we are there to see to the fact that how to mitigate or how to alleviate the quantum of risk to which a particular business is exposed to. And with the availability of advanced financial information related to a future span of time, obviously we are there to be better off to manage the risk and quantify the risk whenever we are in need for executing any risky decisions related to finance. Then the next is strategic planning and growth. Obviously, in this competitive world of business, unless and otherwise we are there to devise different strategies, we cannot win over our peers, and at the same time we cannot avail of an edge over our competitors. So for that, strategy formulation is more or less one of the most pivotal aspect of business community nowadays, and financial forecasting significantly contributes towards that. Then there comes performance monitoring. By facilitating a comparative orientation between the forecasted figures and the actual figures, we would be able to dig out where lies the deficiencies, where we are lagging and where we are better off. So the forecasted financial information also serves as a base for appraisal of financial performance of a business. Then there comes enhancing operational efficiency. If we are given a target well in advance that we are there to achieve it, definitely as the employees we are thriving our best and we are contributing everything to come up to that expectation and to accomplish that target or that particular benchmark. So indirectly it appraises the operational efficiency and also enhances it by providing information well in advance about different functional domains of a business. It facilitates competitors' analysis. Like we are competing in the market, the competitors are also doing the same exercise when they are competing with us. So it also facilitates the competitors to execute an analysis about our states of affairs if we are going to go for pro forma income statement, pro forma balance sheet, pro forma cash flow statement, which more or less accommodates different futuristic information related to financial variables of the business. Then there comes cost control. As I said, if we come to know well in advance that we are there to perform this sort of activities and the quantum of resources are there to be committed, we can exercise cost control or cost reduction strategies or cost management strategies, which will ultimately contribute in a favorable orientation so far as the maximization of profit is concerned, so far the business. Then the last is long-term financial stability. We all know that the future is unknown to each and everybody corporate, but at the same time, we are thriving our best to ensure a sustainable movement in business so that we are there to ensure financial stability of the business. But there are a lot of forces which are threatening the extent of financial stability owing to different unfavorable orientations as a consequence to dynamics of market, dynamics of business, dynamics of sector, dynamics of resource availability and so on and so forth. So when we are talking about financial forecasting, it also contributes towards ensuring long-term financial stability. Then there comes the challenges. When we are talking about the challenges of financial forecasting, there are many, owing to the simple reason that we are dealing with the future and future is unknown and uncertain in most of the cases. We are making a valiant and sincere attempt to read and unfold the future states of affairs of a business in financial orientation, but at the same time we all know that whatever technique or method of financial forecasting we are there to make use of, that cannot be made absolutely objective. There prevails some sort of element of subjectivity when we are talking about the task of financial forecasting. So it is not free from challenges when we are talking about financial forecasting. Here I have jotted down some of the common challenges to which the act of financial forecasting is always vulnerable. Now the first one is uncertainty. Predicting future events with accuracy is difficult due to changing market conditions, economic factors or unforeseen events. Now uncertainty, just have made a mention of the same fact that when we are making a journey into the future, we are surrounded by uncertainty. We do not know what conditions are likely to be there in a future span of time, what challenges we are going to encounter while performing different operating or non-recurring activities within the context of business. And we all know that the execution of all these activities are going to be severely influenced and dictated by these forces of uncertainties, which are beyond the control of the body corporates. So irrespective of the use and application of the best of the methods of financial forecasting, there prevails some sort of uncertainty, and that is always capable of distorting the values of financial variable in a future span of time. Then the next is data limitation. All these quantitative methods of financial forecasting are heavily relying on the past data, but at the same time we all know that the financial data available in lieu of income statement, balance sheet or cash flow statement or any other document are prone to manipulations, are prone to misrepresentations, are prone to window dressing, and also there prevails distorted disclosure. So, how to overcome from such prevalence of these adversaries to financial statements? And when there prevails adversaries to financial statements and we are making use of the financial data which are made available to us, obviously we are going to have data limitations. This is one aspect of data limitation. The other aspect is that many times we fail to get access to different sensitive information related to finance, which are very much essential at the end of the users community so far as financial decision making is concerned. So, whether the data is available in an accurate orientation without any manipulation, and the second issue is that whether we are getting access to that particular data. It may so happen that the data is available, but we fail to access such data or information on the basis of which we are going to execute our financial decisions. So, there prevails data limitation. Then there comes assumptions. When we are reading the future and making a journey into the future, we are carrying a number of assumptions related to conditions, related to the execution of activities, related to different methods, related to techniques of appraisal, techniques of measurement, and putting all these together, financial forecasting is not practically viable without assumptions. So, there must be the prevalence of assumptions whenever we are talking about financial forecasting or making a journey into the future. So, we all know that assumptions are not realistic all the time. Whatever we are assuming, it is more or less an outcome of our intellect, an outcome of our cognitive thoughts. But all the time, these assumptions are not going to suit to the real world conditions. So, if our assumptions are going distorted so far as real world conditions, obviously the forecasting based on such assumptions are going to be inaccurate and it cannot be relied upon as the forecasted financial data whenever we are talking about the task of financial decision making at the end of the users community. Now, to wind up, when we are talking about financial forecasting, we all know that it is the very cornerstone of financial decision making and serving the very purpose of all the stakeholders communities backed by varied objectives so far as the financial aspect is concerned in the corporate world. But at the same time, it is not free from impediments. So, whenever we are talking about financial forecasting, we are there to go for a very systematic and scientific orientation so that we can take the maximum out of the task of financial forecasting and we can make use of the outcomes of financial forecasting to facilitate an informed and rational financial decision making which serves the vested objective at our end. Thank you for your attention. Thank you.